Geopolitics dominating the headlines, but there is also significant economic news on the domestic front. The U.S. IHS Market Flash Composite PMI report. Okay, that's a mouthful. It basically gives us an indication of the health of manufacturing. For February shows that economic activity rebounded in February following Omicron's surge over the holidays. So here's a number, 56. That's a big jump. Now, both the manufacturing and service sectors reported strong output, with employees returning from sick leave and substantial gains in new business. And then February growth comes as consumer confidence hit a 5-month low, with inflation at its highest point since the 1980s. That's to be expected. But what does it all mean for investing? And then you superimpose that over what's going on in Ukraine and Russia. And we said we got to get Charles Schwab Managing Director and Chief Investment Strategist Liz Ann Sonders in here. She's joining us in a Fox Business exclusive. First, Liz Ann, can you give me a sense of how you view what's going on in Ukraine right now with Russia invading? And we see the Dow has cut its losses in half on one speech by the president. How do you speak to investors about what is happening right now?
Well, I don't have any particular expertise in terms of what is actually happening over there and what the next headline is going to be. But we clearly see that whether it's pre-market or an intraday basis, pre-open, you can see that it is more than just moving the needle. Headlines in both directions. And I think that is the dominant, very short-term driver of the market. In the context of volatility more broadly, I think being a function of where we are in the monetary policy cycle and Fed tightening. And I think ultimately what matters for the market in terms of in general, geopolitical tensions, invasions, possible protracted military events is, first of all, the length and severity, whether it turns into a global economic event or whether it's more short-lived. And the more short-lived ones have had a more short-lived impact on the market. But I think in this unique period of time, it's the channels through energy markets that are most important in terms of how it affects the global economy, the U.S. economy, and if there's a reaction function as a result of that by the Fed. Not yet, but that's, I think, how it's going to be felt.
Well, inflationary pressures across the private sector are absolutely outrageous. We keep hearing this during earnings reports, but you bring up energy. We saw what's been going on with commodities. We've got, heating oil up 1%. We do have natural gas up 1.25%. That's sort of in the eye of the storm when it comes to Ukraine and Russia. But overall, is this an area that has done very, very well over the past 6 to 10 months? Does this continue?
So I think energy has done well for a lot of reasons, not least being the surge in oil prices up to 95 recently, back down to 92 and change, and generally the energy complex pricing being strong as we came out of the lockdown phase globally, and you saw that surge in demand, and then you add geopolitical tensions into the mix as well. And it is by far the best performing sector over the past 12 months. As of the recent high in the sector, it had twice as much performance in the past 12 months as the second best performing sector, which is financials. But there's been a ton of volatility along the way. In fact, in those 12 months of energy being the dominant performer, there were more months where energy was the worst performing sector in a month than it was the best performing sector. So you did have to go through huge waves of rotation and volatility. And now we're in a situation where breadth statistics actually couldn't have gotten any better. For weeks, we had 100% of energy stocks trading above 50-day and 200-day moving averages. That started to tick down. At some point, breadth gets so strong that when it hits that 100% threshold, there's only one direction it can go. That doesn't suggest a collapse, but I think from a technical perspective, we probably got a bit overbought.
Okay. Do you look at something like tech, which has been, some would say, a bit oversold, and say, well, now we start to see some value here? Are there favorite sectors that you have beyond what we've discussed?
So tech I think you can't look at really any sector in the market or even subsector or cohort like the FANG stocks or the Big Five or the Super Seven, whatever category you want to use. You can't look at them monolithically anymore. We are seeing what's happened in the FANG Plus type stocks where, you have a couple that have been taken out to the woodshed, others have been more resilient. And I think the same applies to tech. It's not a monolithic thing. And what's interesting about tech, we think of it as a growth sector, and for the most part, it lives in the growth indexes. But the stocks that screen best on value factors within tech, so strong free cash flow yield, EBITDA yield, earnings yield, those have been the stocks that are performing best. So I think you have to take a high quality, reasonable value approach, but don't just apply that screening, if you want to call it that, to just the value areas. You can be a value investor and find tech stocks and consumer discretionary stocks, communication services stocks. I think that's often missing in this growth versus value debate. I talk about it in the context of the characteristics of growth and value, not the predetermined sectors that live in the growth and value indexes.
Well, you got to look at both the jockey and the horse, the leadership, but also the actual company and what they do on a quarterly basis. They've got to hit it out of the park when it comes to at least cash flow, everything else we've been dealing with, whether it's Russia, Ukraine, the pandemic, inflation, and we're just waiting for another lightning bolt to strike around here. Liz Ann, great to have you. Thank you very much for joining us.
Nice to see you, Liz. Thank you.